From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Hi, welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
You know, it's time for us to go over a couple of different concepts, not any math at all whatsoever, but we're going to go over the option pricing models. And it's important that you understand conceptually how they work and not be intimidated whatsoever by the fact that there is, in fact, a mathematical calculation, a formula that somebody actually won a Nobel Prize for creating.
Well, it's actually a heavy formula, and like you said, I mean, anybody that wins a Nobel Prize for anything obviously did something right. And the neat thing about this is it's such a time-tested model that it won a Nobel Prize almost 30 years after it was built.
Right.
And there's been other models after that coming along, but the fact is that we don't need to do the math. Somebody's already figured that out for us. And we've got a computer and a platform that in real time does all these calculations for us. I think the real important thing here is to forget about the math. It's not a math class. What we need to do is look at the concepts behind the model. What makes the model work? And when it generates that theoretical value, along with a couple other things it throws out that people aren't aware of, but when it generates that theoretical value, we know where that number came from mechanically, not mathematically, but mechanically, and that gives us a better understanding of the number, which in turn allows us to make a better decision based on that number.
Well, once you do that and you have that foundation, you just have the concept down, you just become a better option trader completely because you start to know the option pricing models inside and out. When I was, when I started in options, embarrassingly enough, I'll admit this right now on television, I actually, I didn't know there was an option pricing model for the first year or so, and I thought that options were just traded based on supply and demand. The price would go up when people thought it was more interesting, which tends to happen, but I didn't realize there was an actual calculation and pricing model, yet I was trading, tons of money on it.
Well, that model, do understand, the models aren't perfect, but you have to start somewhere.
Of course.
I mean, you have to have some type of value. You can't go down thinking that something's worth 10 and I think it's worth 80. I mean, there's got to be some type of beginning, some type of spot where we start from.
Yeah.
And that's all the model really does is give us a theoretical value. From there, we can start basing and adjusting and changing, what that value means and how the market accepts or doesn't accept that value. But it's where we got to start. You have to understand at least the mechanism, and we're not going to really get into the math. It's already done, so.
No, so don't feel intimidated. This is pretty easy stuff. Once you have the math down and you understand the concept of it, you're going to have a calculator. You don't have to actually do any numbers in your head or with a little piece of paper and a pencil. You're just going to type in a couple of values into an options calculator, and it's going to spit out a theoretical value. But now we're going to understand how it reaches that value and why that works.
And and on top of that, the people that already have, their own account and they have a brokerage platform, those numbers are done there on the computer for you. So it's nothing to be afraid of, but it's definitely something that really helps build a strong foundation. The stronger the foundation, the higher the building. So we've got to start working on the foundation. The option pricing model is where we need to start. And let me show you about some of the concepts behind the model I'm talking about.
Let's do it.
What we have to keep in mind about the option pricing model is that it's just simply a tool, a very simple tool. Many of you probably already use tools. You use charts in your stock trading now. The chart isn't the do-all, end-all, say-all of what's going to happen. You use it as a tool. It helps you make decisions. You have to look at the option pricing model the same way. We need to begin somewhere. We have to generate an idea of what the option is worth. And that's all the option pricing model does. It's not an accurate thing in terms of to the penny all the time. Too many people think that the pricing model solves the question as to what is the option exactly worth, period. It doesn't. It gives us a good start, where to start from. Now, before we get into the pricing model, I want you to take a look at these sheets that you have. They're called trading sheets. We're going to be referring to them off and on during the course, especially when we're going to be talking about the individual strategies. And I'd like to go over these sheets with you because these sheets were actually generated from a system that has an option pricing model in it. So let's take a look at these sheets real fast. First off, up at the top, you can see that these sheets were being used by a trader in Qualcomm. These are theoretical values from Qualcomm. And who's putting out these theoretical values? It's a system called MicroHedge, which I don't think exists anymore. But these trading sheets are going to be very valuable for us when we start playing with the strategies, getting an idea of why certain options are priced the way they are. Now, how do we use these things? Well, quite simply, what we have is right here at the top, this strip right here, they are all stock prices. And down our left-hand side, we have option months and strikes. In order to get an understanding of what the theoretical value for a certain month and strike is, for a certain stock price, all we have to do is play this little grid game. So if I was looking at the June 60s, with the stock price of 65, I take my finger on June 60, come right across to where I have a stock price of actually 65.50. That first value you see there, $5.74, that value right there is the theoretical value of the call. Right next to it, we have something that says 18 cents. Everybody see that? 18 cents is the theoretical value of the put. Two other little items that we want to take note of. Right below the call's value, 574, right below the call's value is another value. It says 91. That is going to be the delta of that call. Delta is a Greek, and we're going to be talking about that later, but this way you'll know where to find it when you need it. And next to it, -9, is going to be the delta of the put. So this way, what you're going to have is anytime that you want to look at these sheets to get an idea of how things are being valued, how we put together different strategies and see what that strategy might be worth, we're going to refer to these sheets. As you can see, these sheets are being run with a 30 volatility. How do I know that? Because this strip right here tells me that every month is being run at a 30 volatility. And also this strip tells me also. With different volatilities, we'll have different option prices. That's why you have 5 different sheets. Each sheet is identical except for the volatility that we're running. This sheet here, sheet number 1, is being run at a 30 volatility. Sheet number 2 is a 40 volatility. Sheet number 3 is a 50 volatility. And obviously sheets 4 and 5 are 60 and 70 respectively. So what we have to look at is whenever we want to get the theoretical value of an option, find the month and strike, pan across to the stock price, top left is your call, the theoretical value, top right is your put, bottom left is the call delta, bottom right is the put delta. And we'll be going back to these sheets, like I said, when we get into the strategies. But those values were generated by the option pricing model. Are they definitely 100% accurate and that is how things are? No, not necessarily. Remember, things change. Markets move. Things go up, things go down. Vol changes, time passes, stock prices change. The model is constantly changing values. You might think it's a lot, but it's really not all that difficult because you're not the one doing the calculations. Remember, these calculations are done for you automatically by your broker. They're right there on your platform. They change in real time. You don't have to sit down with a compass, a protractor, a slide rule, and try to figure this stuff out yourself. The importance right now is for you to understand the concept. What is the model doing? Why is it doing it? And with understanding that concept, you'll have a much better understanding of what an option is, what affects its price, how the price is generated, and what's going to make that price change. So keep that in mind. Don't get intimidated by the option pricing model. Remember, it's a simple tool, like any other tool. Remember, when you're going to work as a carpenter, you have an entire tool belt, don't you? You don't just bring a hammer with you. You bring many tools. The pricing model is just another one of those tools. Now, what we have to know about the pricing model, it's an economic algorithm. That's all it is. And I'll tell you how it's going to work in a few minutes, and you'll see how it works conceptually. We're not going to get into the heavy math. We're not mathematicians. We're investors and traders. We don't have to worry about the heavy math. But it's an economic algorithm, and actually it's a pretty impressive one. The original model, put forth by Black and Scholes, actually won the Nobel Prize in Economics in 1997. This model was put together back in 73. So when you talk about, the integrity of a pricing model, you're talking about serious integrity. This thing has been working and running for a very long time. Now, is the Black-Scholes model one of the best models still to this day? No. But the fact of the matter is it's still used by many people and it's still used well. What is the model then? It's a probability model. Remember, anytime we're trying to predict the future value of something, we have to go by guesstimate. We don't have a crystal ball, and the model is not a crystal ball. What we need to do is go with probability, the likelihood of occurrence. That's how we predict the future. You might say, hey, who's going to win the Super Bowl this year? Well, I don't know, but based on performance of the past few years, I can give you a good guess as the teams to watch. Same idea here. We're dealing with probabilities. Now, with these probabilities, we have an expected value that's generated. That expected value of that option is actually the theoretical value, a value in theory. With all things being equal, with all of my inputs being accurate, this is what this option should be worth. Does that mean that nothing will change between now and then? Of course not. The value will change as different situations come to light, as different things take hold of the market, as stocks go up and down, as time goes by, as volatility moves, as the economy surges and retracts. These different prices are going to be changing. We have to understand that. The model not only gives us a theoretical value, but it also gives us something else that's very important. It generates risk sensitivities. The model actually tells us and quantifies for us how much the options price will change with a changing of any of the variables. That's very important when we talk about risk management in the future. If I know exactly what could change the price of my option, and I know exactly how much it'll change, then I'm going to have a real good idea of where my risk lies. And that way I'll be able to hedge against that situation, or at least be ready to before I make the trade. So the first of the inputs is obviously the price of the underlying. And normally I talk about stocks, but it could be any underlying at all. It could be currency, it could be a future on a commodity, it could be anything. But let's just talk about, stocks right now. So the first input of the model that I need to have is I need to have the stock price. We need to know what the stock price is right this second. The second is I need to have the strike price. I need to know at what price I'm going to be buying or selling this instrument in the future, because that's going to determine whether or not, or to what degree or not, I have a chance of this strike being in the money. I need days to expiration. It's a big difference if I'm going to set my days to expiration for near term, something maybe 20, 30, 40 days out, or 6 months, a year out. There's a big difference. The model needs to know what type of time period we're talking about. We also need to know the interest rate. Remember, if I wasn't buying something, that money that I'm spending would be where? In my account, earning interest. I need to make sure that whatever asset I'm purchasing, I'm going to get better performance from it than the risk-free rate of return. I also need to know about dividends. You might say, well, wait a second, we're talking about options. Options don't pay dividends. Why are we looking at dividends? Well, take a look at this factor here, stock. if we're talking about using stock as an input to the model, then we better be talking about things that also affect the stock, interest and dividend. And it's funny because these two together, interest and dividend, create something called cost of carry or carry cost. These are the two expenses that we incur when we are holding on to a position. Remember, interest I would collect if my money was in an account. Now that I'm purchasing something, I don't have money in my account anymore. That means I won't be collecting interest. If I sold something, money would be coming into my account from the sale. And because of that, I would now have more money in my account, which would collect more interest for me. So we have to make the adjustment for interest rate. Dividend also. If I own stock, I'm going to get a dividend. But if I'm short stock, I own that dividend out. We have to take into consideration these costs of carry. Why are they called costs of carry? It's the cost of carrying the position. So interest rate and dividend don't necessarily affect the option price directly. They more affect one of the components. So interest rate and dividend or cost of carry affects the option price indirectly. Now, here's a topic that you probably look at and say, oh, I remember this. That's that fungus that grows on your toenails, kurtosis, right? No, unfortunately, kurtosis is not something that can be cured with a little triple antibiotic. Kurtosis is actually an effect that occurs to the bell curve, which we see in today's markets, that really only applies to a certain specific type of model, the VSK model. And we're going to talk about that a little later. Another one of those special inputs is skew. Again, you might say, what is skew? We're going to get to what skew is. But the thing is, again, it only applies to the VSK pricing model, which is a very high-end model. Not a lot of people use it, and it's not available in too many places. You got to be kind of special to get that model. Maybe I'll give it to you. We'll see how you do in the course. Finally, we come to volatility. The final input into the model is volatility. There's a reason I left volatility for last. And that reason is, as a buyer or a seller, volatility is going to determine which one you're going to be. All these other inputs are fixed between both the buyer and the seller. Volatility, however, is the only one of these inputs that will be different. It's what makes a buyer and a seller. The fact that you and the other party in the contract have a different volatility assumption. Now, how does the model actually work? Don't run, don't go anywhere, stay here. I'm not going to throw all these crazy formulas on here and make you do, long multiplication and division. Don't worry. I'm talking about how the model works from a conceptual idea. First, this is what the model does. It takes the current price of the stock, the volatility and the amount of time that the option is going to have, and it calculates a probable amount of occurrences within a range of values for that given period. Remember, when we talk about volatility is going to determine for us what the potential range of the stock is for our given period of time. You might say, well, why do I need to know what the stock range is going to be? Because remember, this is a probability model. We don't know where the stock is going to close come time of option expiration. What we do know is where the option will be priced if the stock closes at certain specific prices. So if we know where the stock closes, then we'll know what the option's worth. The model doesn't try to figure out what the option's going to do. We already know what the option's going to do if we know what the stock does. The model actually tries to calculate the probability of the stock closing at all sorts of different values and then says, now that I have a general idea, I know what the percentage chance of the stock closing here is, and here is, and here is. Now we know what the option will be worth at those different levels. So what are we doing? We're not really trying to find option prices. We're trying to find out percentage chance of future stock outcome. We need a range, and inside that range, we need probability as to whether or not the stock will finish there. Once we have that, now we can determine what the options price would be at every one of those given spots. Now, here's the thing. You might say, all right, that makes sense. If I can figure out where the stock is going to be and the percentage chance of it being at different locations, I can then figure out what the option's going to be worth times what the option's going to be worth times what? The percentage chance of the stock closing there, and I get a value. And I add up all those values for that entire stock range, and I get the expected value of the option. Sounds easy enough, right? But here's the problem. How do we assign probabilities? If the stock is trading today at 50, how do we know what the percentage chance is of the stock closing 6 months from now at 60, at 40, at 37.25? We have to be able to somehow assign probabilities to the specific different outcomes inside the range of potential places the stock can close at. We use a bell curve to do that. Most of you are probably familiar with a bell curve. I know for me, I would have never passed physics without a bell curve. So I am very aware of bell curves. All a bell curve is doing is generating the probability of outcome of where the stock is going to close at expiration of the option we're looking at. So once we have that range, we understand that volatility in time will give us the range of stock values. From there, the bell curve will assign probabilities or percentage chance outcomes at each of those prices. Once we know that, we can figure out what the value of the option would be if the stock closed here, or here, or here. And then from there, we take all those probable outcomes, take their percentages, times them by what the option would be worth if the stock did close there, add them all together, and you have the value of your option. So basically, when you look at the option pricing model, don't think it's really trying to figure out what the price of the option is. It's actually trying to figure out where the stock's going to be at expiration. That will determine what the option's price will be. So we're really looking for stock outcome. Where is the stock going to be? So when the pricing model really starts to get into action, it literally calculates what the option's value would be at every one of the probable price outcomes for the stock. A stock today, if we have a stock that's trading at $50 today, we don't know where it's going to be in 6 months, but we do have some generalized guesses as to where it would be. We first identify the range using the volatility, and you might say, well, how does that work? Well, let's take a stock, for instance, it's trading at, I'll make the math easy for you, $100. We have a stock trading at $100. And let's say that we have a volatility of 30. 30 meaning 30%. Volatility is given in percentage, annualized percentage terms. So if we have a stock that's $100 today that is going to trade with a 30 volatility for 1 year, we know that the range of that stock will be 70, which is down 30, to 130. Why do we know those ranges? Well, volatility takes the percentage of the value of the asset and says, hey, the stock can trade up or down by this percentage. So if we're using 30 volatility on a $100 stock, that's $30. $30 potentially down, $30 potentially up. If the stock is currently at 100, $30 up is 130, $30 down is 70. There's our range. So now we have the range. Now that we have the range, we want to say, okay, well, what's the probability of stock staying right here at 100? Versus what's the stock possibility of trading 110 or 120 or 70 or 80? We have to add up all those different probable potential outcomes. That's what the model's doing. It's assigning probabilities using the bell curve to all the different potential outcomes. Once we have that and we know what the option would be worth, now we can say, all right, let's run an expected value calculation, and now let's figure out what the option is worth today. Now, once the model takes all those different values and adds them together, it's got one more job to do. And that one more job that it needs to do is to take the net present value. Remember, we're going to be spending money today, and we need a return when? Sometime in the future when this option expires. Problem is that the money that we're using today could have stayed in the bank, making us what? Interest. So that's why interest becomes important in the calculation. We need to take the net present value of that future price of the option. So after we have an idea that, hey, the option's going to be worth $2, we need to then take the net present value of that, giving us a value of what that option is worth today. Not what it's going to be worth, but worth today, discounted for time. So what we need to talk about first when we talk about the pricing model is some of the fundamentals, some of the foundations of the pricing model. One, Brownian motion. Some of you might have heard of it. Some of you might not have heard of it. Random walk theory. Normal distribution. I'm pretty sure you heard of bell curve, right? Because without the bell curve, most of you wouldn't have finished high school. Standard deviation and theoretical value. These terms here you should be somewhat familiar with. I don't need you to give me a textbook definition, but you have to have a general idea of the concept, because the pricing model is built upon these concepts. Some of these concepts are more important than others. Some of them might actually show some flaws that show up in the pricing model itself. Let's talk about Brownian motion first. Brownian motion, when applied to the stock market, basically says that stocks are capable of spontaneous movement. They just move one day. Some days they don't, some days they do. And they don't need a reason. Now, obviously, stocks have to move for a reason. When you see a stock that's moving for no reason, it normally means that there is a reason, you just don't know what it is. So for you, the stock is moving spontaneously. Brownian motion is important in that way, with the idea that you need to know, and the model needs to know, that the stock can move whenever it wants and in either direction. Now, as I said, I think this assumption is a little flawed. Just because I don't know why something's happening doesn't mean there's not a reason. To be honest, if a stock starts to move, there is a reason, and I guarantee someone knows what that reason is. Odds are you and I aren't going to know what it is, so it looks like it's moving spontaneously. Now, if there's not a reason for a stock to move, then it shouldn't move. And what you're going to find out is stocks have a tendency to not move more often than they have a tendency to move. So if there's no reason for the stock to move, it's going to stay still. Our next foundational point that we want to talk about is random walk. This one's probably a little more important than Brownian motion. And actually, most of you will probably have heard about random walk when you are talking about the market. Now, when we talk about random walk as applied to the market, what random walk says is that a stock has an equal chance of moving up from where it is currently and down from where it is currently. Every time we come to a new stock level, a new stock price, it's a 50-50 chance from there to the next step, either up or down. Personally, I don't necessarily think that's true. However, the model does think about the concept of random walk. Stock can move up or down equally with the same percentage chance at every level. It also says, random walk, that a stock's next movement has nothing to do with its last movement. That means that the movement of the stock is not determined by what has happened before. Right off the bat, for those of you that are technicians that like using technical analysis, you would see that random walk is 100% in dispute of the value of technical analysis. Random walk, if true, basically says that technical analysis is incorrect. I happen to be a believer in technical analysis, so I'm not a believer in random walk. But that is what the model is based upon. The idea that a stock's movement, its next movement, has nothing to do with the last and can be either up or down in a 50-50 percentage chance, which also kind of argues the idea of momentum, doesn't it? So that means that stocks can rise or fall from any given level that they're at with a 50-50% chance. There's never a moment in time that we could say, hey, looking at what the stock has been doing, I think the stock will continue in that direction. What does this mean? It means there's no such thing as a trend. I personally believe in trends. I'm sure you do too. So you can already see some of the flaws with taking the theory of random walk and putting it directly into the market. Do understand our models that are giving us option prices are based upon random walk. So, random walk basically dispels any chance of the legitimacy of technical analysis, of charting, of momentum, of trend, of any idea or concept that can help us predict the stock's next movement. Random walk says, no, none of that is valid. That's why I don't believe in random walk. But it's something that I have to be aware of, something that you need to understand, because random walk is one of the foundations of the pricing model. The model that's giving you the theoretical value that you are going to make decisions off of. So, if random walk was true, there would never be any charting patterns. There wouldn't be charting. Everything would be just a coin toss at every single level. And that's how the pricing model treats stocks. That at every different level, up or down, is just as valid and in equal proportions. Now, remember, the model is a starting point from finding values. Don't think that now the model's ruined. Hey, I don't believe in random walk. The model's based upon random walk. And let me tell you something. I can't use the pricing model because it's based upon random walk foundationally. Do understand, we know that already. We already know it's not 100% accurate. But we do need a general starting point. So that's why me, being a disbeliever in random walk, still believes in the option pricing model. I understand the value of the model. I understand that it's just a tool. That's the way you have to look at it. Okay, now putting this all together, the easiest way for me to demonstrate what happens here is an old-fashioned game that I'm sure many of you are familiar with called Plinko. Plinko, one of those things. See, I'm very young. I wasn't around when you guys were playing this game. But I'm hearing it's called Plinko. And what happens is, let's take a look at some of the foundational elements we just talked about, look at how it fits into the Plinko game, and then how the model builds our normal distribution, our bell curve, off of this. Here we have the ball that goes down in the Plinko game. You remember you used to get points for different places here, and the ball would go down and bounce off all the pegs. First, we have to have the ball go into the game. How does the ball go from just being here itself to into the game? Brownian motion, right? It's just sitting here. How does it get into the game? Brownian motion, spontaneous movement. The ball starts to go down into the game. Just the same way the stock starts to move in one direction or another. Every time the ball hits one of these pegs right here, it has what? A 50-50 chance of going either left or right. When we hit this first peg, here the ball went to the left. The ball could have just as easily gone to the right. What is that? There's our random walk entering into the picture. Every single peg, when the ball hits that peg, the ball could go up or down. Well, actually right or left. That 50-50 chance on hitting every peg is like the stock having a 50-50 chance of going up or down from every new stock level. The peg, in a sense, is like the stock level. Once we get to that stock level, the ball hits it, it could go left or right equally. Random walk. As the ball finally hits these pegs all the way down, what do we have? We take a look at the potential outcomes. We send ball after ball after ball after ball down, and what do we have? All of these potential outcomes, and as you can see, they form a bell curve. This is where the probability of stock outcome comes in. In the same way we take a look at the stock price right here, we run it through, and then it winds up somewhere. Stock is right now at 50. We run it through, it winds up at 52 at expiration. We do it again. This time the stock wound up at 50. The next time it winds up at 47. The next time, every one of these balls goes down, starts with what? Brownian motion to get it into the game. Stock's got to start moving. Then it hits each one of these pegs. And when it hits the peg, it can go right or left. The peg is in the new price level. Right or left, 50-50, random walk. Coming down in and forming what? Our bell curve. Now, we need to know how many balls go to the right, how many balls go to the left, how many balls go in the middle. This is our outcome. This is how we determine what the percentage chance is of the outcome of the stock. As you can see, we sent a lot of balls down here. Most of the outcome was right here in the middle. It turns out that the Plinko ball didn't go too far to the left or too far to the right that often. Most of the time, the Plinko ball stayed somewhere in the middle, just like in the stock market. Stocks normally don't move. Where they start is normally around where they finish. However, every once in a while, we got a ball going a little to the left or a little to the right. And we got some balls, every one, rare occasion, but once in a while, we got balls that move way out to the sides. Standard deviation comes in by defining for us what percentage of the outcomes fell in certain areas. That's how we get the probability of each potential outcome. Standard deviation. You've heard of one standard deviation, two standard deviations, three standard deviations. They help define for us the percentage outcome or percentage chance of the stock finishing at any of the different prices come expiration. So the option pricing model can't be all that difficult. It's like a Plinko game. Now, when we take a look at the pricing model working over time, what happens is, say if we're looking at a 6-month option, 6 months, what we need to do is we need to build a bell curve over the current stock price out 6 months. That bell curve would then give us a range of values and the percentage chance of the stock finishing up above 50, down below 50, or right in the 50 area. That is actually a good depiction of what is happening here. When I look at a 6-month option, the model is saying, okay, let's go out 6 months, and now let's draw our range. We know that volatility helps us here, right? Volatility is helping us determine how much of a range we have here. More volatility, more range. Less volatility, smaller range. Once we have the range, then we can figure out the probabilities of occurrence inside that range. That gives us an idea where the stock finishes. And if we know where the stock's going to finish, obviously we know where the option price will be. So, what is a normal distribution? Well, the couple things you need to know is when you talk about a normal distribution, you're talking about a bell curve. And as I said, I passed physics, thank God, for the bell curve. The shape is going to vary from stock to stock. Bell curves have some similar characteristics. One thing we know about a bell curve is it's got to be symmetrical. That means chance of occurrence to the right is the same as chance occurrence to the left. A stock going up $10 has to have the same percentage chance as the stock's ability to go down $10. Where do we get that from? That's the random walk jumping in, right? Stock has to have an ability to go in either direction equally in the same percentage chance. So there's where our random walk is coming in. So we know that these bell curves are symmetrical, same percentage chance each side. However, the shapes of these bell curves varies. Sometimes the bell curve is very skinny and very tall. Other times it's kind of short and fat. So these characteristics are important to understand because these characteristics are going to help us determine range. A stock that's more volatile will have a wider range, thus the bell curve will be shorter and fatter. And we'll talk about that. A stock that trades in a narrow range with not a lot of volatility, it's going to be taller and skinnier. So these bell curves have very similar characteristics, but they're not identical. They've got to be symmetrical. They've got to have 68.4% of all outcomes fall within one standard deviation of the mean. They have to have 95.4% falling within 2 standard deviations of the mean. And they have to have 99.7% of all occurrences fall within 3 standard deviations of the mean. As long as a curve has those characteristics and is symmetrical, it will be a bell curve, no matter what the shape looks like, tall and skinny, fat and wide. So these things are symmetrical. Now remember, if you don't believe in random walk, then your bell curve probably won't be symmetrical, will it? We'll talk about that in a little bit. But normal distributions are symmetrical. They're saying that the stock has an equal chance of being higher or lower in the same percentage. Now, we came up with some numbers there. I said 68.4% of the time the stock will be within 1 standard deviation of its mean. What we need to know is that's great, but is it going to be to the right of the mean or the left of the mean? What does our bell curve tell us? Well, obviously our bell curve being symmetrical, being random walk saying half and half, 4.2% should be to the right of the mean, 32.4% to the left of the mean, but inside the 1 standard deviation. Now, if that's true, that means roughly 70% of the time a stock doesn't go too far away from where it's currently priced. That goes back to the idea that stocks stay still more often than they actually move. Well, here's a very bright, colorful picture of a bell curve for you, defining the percentage chance of 1 standard deviation in red, 2 standard deviations in green, and 3 standard deviations in blue. As you can see, the chance of a 3 standard deviation one-day movement is kind of low. It's few and far between. 2 standard deviation movement is what? Less than a little over 30% of the time. It's only 3 out of 10. 7 out of 10, the stock is staying right here, scrunched around the mean. Both of these are normal distributions, but they look dramatically different, don't they? What do we have on the left? We have a standard distribution, normal distribution, that is a bell curve. It's symmetrical. And as long as the numbers fit, 68% being within one standard deviation of each side of the mean, 95.4%, 99.7%, 2 and 3 standard deviations, we have a bell curve. Low volatility situation, higher volatility situation. How do I know? Look at the indicated range. Look at the range right here. That's a lot smaller than this range right here. Why? Because a stock with more volatility has a wider range of potential outcomes in the future than a stock with lesser volatility. This is what we need to know. This is how volatility affects option prices, because it affects the range of outcomes of the stock. Standard deviation. Don't think that standard deviation is the do-all, end-all of probability. It's not. It's going to help us with probability. Is it going to be close? Yes, it's going to be close enough. What standard deviation is telling us is that a stock is going to trade within 3 standard deviations 99.7% of the time. That means 99.7% of the time, the stock is going to be within 2 points. The odds of it getting outside those 2 points are what? 0.3%, which is not much at all. So when we look at the overall potential range of a stock, we need to understand that we're going to be pretty doggone accurate with getting the range right. Standard deviation really helps us give us an idea about dispersion. How often does this stock really move wildly to the right or to the left? And where is wildly? How far out is wild? The bell curve is using this to throw probabilities on potential stock outcomes. Is it perfectly accurate? The answer is no, of course not. Is it close enough to give us a good guesstimate at the probable outcome of the stock? Yes, it is. In this way, using the bell curve, using standard deviations, we get a very good idea of not the range, because remember, time and volatility are going to give us the range. But what's the percentage chance of the stock finishing at expiration at different levels inside that range? Remember, we could have a really wide range. That really wide range isn't going to help us at all to figure out the potential of an option price if we can't throw probability into the mix. The models, almost every one except 1 or 2, the models use the bell curve and standard deviation to assign us probabilities of stock outcome in the future. After the model does all this, after we input all the things that the model asks for, and the model crunches all these numbers, after all this, the model finally does something for us. It spits out a value. It says, hey, this is what I think this option is worth right here, right now. Theoretical value. Value in theory. Again, it's a starting point. It's not the definite, absolute, actual value. No one knows that. We're talking about trying to guesstimate something that's going to happen in the future. But it's a very good starting point to give us an idea of where this option probably will wind up, thus giving us what it's worth right now. Theoretical value. We need to start somewhere. Now, ultimately, theoretical value is going to be determined by the midpoint of the bid-ask spread. If I have a bunch of people who want to pay 3 for a certain option, and I've got people that are willing to sell that certain option at 320, where do you think fair value or the theoretical value of that option is? Obviously, it's got to be more than 3 because we got all these people who want to pay 3. It's got to be less than 320 because we got a lot of people that want to sell at 320. Obviously, it lies really in the middle. This is why we call it theoretical value. The true value of the option at any one given time is the price at which we can find somebody who wants to buy and somebody who wants to sell. An actual trade. When that trade occurs, that's the real value of that option at that immediate time. Doesn't really necessarily matter what the theory says, because it's actually trading in the real market with people who want to actually buy and sell. So when we're looking at theoretical value, our theoretical value might not always match up exactly with where the option is trading at the time. That's why it's a theoretical value. It's not a real market value. That's the difference between market value, what something is really trading for, and theoretical value, what something should be under certain situations with certain variables should be trading for. So we really have to look at the two of these things. Where is it really trading? The midpoint giving you the real, true, fair value. And where should it be trading based upon my judgment, theoretical value? Now, when we're looking at this, what's going to separate something really trading from theoretical value? What's going to be the determinant factor between buying and selling? How do I get someone to buy at 3 when I want to sell at 3? Volatility. Ultimately, volatility is the key to buyers being buyers and sellers being sellers. It all comes down to volatility. The volatility assumption of the parties involved. Now, there's a lot of option pricing models out there. So the first one, as I said, is the Black-Scholes model. It was the grandfather. Now, there were a couple that came before, and we saw that in our little evolutionary family tree. But the first one to gain real notoriety was the Black-Scholes. Now, we said it was created in 1973. It's a long time ago. I was born, but just barely. Anyway, the fact is this model had been around for 20-some years before winning a Nobel Prize. We're not sitting here making the statement that the Black-Scholes model wasn't unbelievably good. But the fact is, like any mathematical model, it's going to have some flaws. It doesn't fit perfectly to option pricing. It wasn't made just to price options. So obviously, the model, although outstanding, is going to have some little problems. It did win a Nobel Prize for economics in '97. So it is a tremendous model. However, the model had some flaws. Number one, it had trouble handling dividends and time value. The problem here is that if I have a model that doesn't handle something well, I've got two choices to make. I can either try to adjust and fix what I have right now, or I can go back and start over. Well, obviously, these guys were not looking to start over. What they did was they had somebody go back and make an adjustment. And it's right on that sheet. It shows a little thing. Merton, he's the one that modified the Black-Scholes to handle specifically dividends. And that's why that model, the one that Merton worked on, it's called the Merton Black-Scholes model, or the modified Black-Scholes model. The other problem here is it also assumed that volatility was static during the life of an option. And we know that that is anything but true. Volatility is changing all the time. Every minute, every day, vol's changing. So we can't have an option that assumes that whatever the volatility is today, it's the same volatility that's going to be going forward. Now, what are we going to do about this? Well, obviously, somebody was asking themselves the same question a while ago. What are we going to do about these faults here? We're going to develop the binomial model. Cox-Ross-Rubinstein binomial model. So what the binomial model does, though, is that although it fixed some of the previous problems that the Black-Scholes model did, or had, it threw in some new problems. We said the binomial model, unfortunately, assumes a stock is going to move more frequently than it actually does. Why? because the binomial model is called the binomial model because it has two nodes. What am I talking about? Nodes. Nodes, think of nodes as paths. From every single price that we have right now, whatever price we are at this moment, we can either go up or down from this price. Now, think about that for a second. Remember random walk saying that we can go in either direction equally. 50-50. We can go up, 50-50, we can go down. What that forgets is a stock going sideways. What if the stock goes sideways? That's reasonable. That's legitimate. We've seen stocks do that. So the binomial model is basically forcing the stock to either go up or down in its calculation. That means it's adding to volatility that might not truly exist because it doesn't have the ability to step sideways. So this model didn't take into account that stocks can very often not move. And we all know that stocks not only very often, they most of the time don't move. So the binomial model, where it fixed some problems of the Black-Scholes, it had some problems of its own. So the problem is that, in a sense, our option is getting valued by the binomial model in a way that suggests that although the stock isn't moving, it should move. Thus, the option becomes a little overvalued. Because remember, the option is priced upon the idea that the stock will move. But it's not priced upon the idea that the stock can go sideways. And that was the flaw with the binomial model. So what happened is this flaw created a situation where the options were often overpriced. Not dramatically, but slightly. Here's a picture of the Cox-Ross-Rubinstein binomial model. And this is what I'm talking about the nodes. And a matter of fact, this picture can also help explain a couple different things. Here we are with the stock price right now. And we know that if right now was expiration and we know the stock price, we would know the option price of any option we wanted to look at. We know that, hey, if the stock is here, this option would be here on expiration. That's how that works. Now, from here, from this level, look what happens. Remember, two nodes. Stock can go up or the stock can go down. There really is no sideways movement for this period of time. Now, Rubinstein argued in an article that, hey, wait a second. If you take it out far enough, there is a sideways movement. Here to here, that's sideways. Here to here. It skips, though, a time period. That means it's not calculating this lack of movement. It's over-calculating. That is the problem with the binomial model. Two nodes, almost in a sense, forcing value onto the option because of a predicted movement which doesn't necessarily occur. There's got to be a way to take this model and account for a sideways move. As you can see, there's our middle ground. The stock, most of the time, doesn't move. Yet we've missed every other time segment in calculating a lack of movement. So that means we've overpriced our options because at every other time segment, we are forcing the movement in the model. Now, although the binomial model was flawed, two guys, Yerkes and Stensland, decided that, you know what? We might be able to make this pricing model, this binomial model, a little quicker and a little more accurate. And they did exactly that. How did they do that? Instead of taking the binomial model, the Cox-Ross-Rubinstein version, and changing it, adding to it, they decided to do something that I think Cox-Ross-Rubinstein would have done. is knock the whole thing down and start from scratch. By doing that, the Yerkes-Stensland model became more computationally accurate and quicker. They didn't have all the little hang-ups that had occurred in the Black-Scholes then occur into what we would consider the binomial adjustment for the Black-Scholes. They said, look, the building it's just not exactly what we want it to be. Instead of just knocking down 3 floors and starting on the first floor and building up, let's go ahead and knock out the whole thing. Let's rip up the foundation, let's leave nothing, and let's take the concept and start from scratch mathematically. That means that the math of the Yerkes-Stensland model is tighter than the math of the Cox-Ross-Rubenstein binomial model. That makes the Yerkes-Stensland quicker and more accurate. Now think about being a brokerage firm. With all the different quotes changing as often as they do, as quickly as they do, and your model needing to do these calculations to pump out new option prices for 4,000 different stocks that each have 4 or 6 months of options in there with 4 or 5 strikes in each one. I mean, it's nuts. The Yerkes-Stensland thus becomes a very important model because now, with more and more stocks, we're going to need to be quicker in the computation. Remember, we need accurate numbers, and we need them instantly. And if our model that's in our platform is taking too long to generate these numbers, well, then our reaction time is slowed. So this Yerkes-Stensland is the first model since the Black-Scholes to really be built from scratch, from the very basic beginnings. That's why it's more mathematically accurate and computationally quicker. Now, did this matter back in the day when there was only a few hundred stocks that had options on them? No. And I think these guys knew that. They sat there and said, you know what, with all these new optionable stocks, we better start thinking about something that's quicker. You could always throw more hardware at anything. We all know that. The first computer built was probably the size of this studio. Now we've got a computer on your cell phone that's this big, that's probably more powerful than that original IBM built in whatever. The fact is that was the idea here. Let's get a model. Let's make things quicker, not by throwing more hardware on there. Let's redo the programming from scratch better. And that's what they did. And that became important because the more optionable securities that there were, the more things changed in price, the more rapid and the more of them there were, brokers need a model that can keep up with it.